Alongside those who have defended our nation, like their human counterparts, many have made the ultimate sacrifice for our freedom. As we all remember those who have fallen, Gateway remembers the animals who have also fallen to help make our nation strong. Gateway Pet Cemetery, serving you today for tomorrow's peace of mind.
With Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone, give us a call, talk mortgages. Mortgages are very difficult to get in some respects. In other respects, they're very easy to get, and I'll explain. Sometimes when you're trying to get a mortgage and you are a perfect fit for a mortgage, i.e. you're a W-2 wage earner, i.e. you get a paycheck every 2 weeks, comes on the 15th and the 30th, and you've been doing that for the 10, 15 years, and your credit score, your FICO score, is above 740, and you are just itching to get a new home, and you are a first-time home buyer, you would probably be eligible for a terrific low interest rate loan. Why do I say that? Is because your risk is low. Let's say you're even in your early to mid-30s. Then your risk is really low, and you're making $100,000 a year. Now your risk really goes down, and then it just becomes a math problem as to how much money you can borrow based on that. Now, it can be difficult to get, and let me explain. If you are a type of person who does not have great credit, who has intermittent or self-employed, it can be harder for you to get a loan. Because why? The risk is greater. And we are at the point in this particular market, just think about it. How long has this market been going on the upswing, where property values have been increasing and interest rates have been relatively low, and they're still relatively low. They're under 5%. How long has it been? If you say 2010 it started, you're right. So that's an 8-year run of this incredible market that we've been in. So the risk to people loaning, to those of you who have bad credit, intermittent, I can't even say the word, intermittent employment history, or are self-employed, are a greater or a less risk for someone lending you money in this type of market. So when you're thinking about borrowing money, when you're thinking about credit or getting credit, I had this client, and they wanted to, their VA, husband served in the Navy, and grateful for his service. And anybody out there who has been in the military, these VA loans are terrific. They're usually less cost, and they're usually less in terms of the interest rate. And they're 100%, and they're 100% guaranteed. So if you're in the military, you earned it, you deserve it, go get it. Get your certificate of eligibility and go get this loan. But what I'm saying is, if you, my clients, they were trying to get a loan, and they wanted to get a loan, and they were happy, they were VA, they were ready to go. But they couldn't find a property. Why? Because this market right now that we're in 2018, is upward trending in many places in the U.S. I can tell you right now that in Las Vegas, Nevada, prices went up 16% year over date, meaning last year at this time to this year at this time, property prices went up 16%. Now, they're not at yet the prices they were in 2004, 5, and 6, but they're getting close. And the fact is that in Vegas, obviously, the prices are a lot lower than they are here in San Bernardino, Riverside. And by the way, KCAA, KMET, and the Roadrunner, as well as K-Tahoe, thank you very much for having our signal and boosting us to all your audience out there. Really appreciate it. We love our audience, and they're always responding. We get terrific response both online and via phone call. And again, that number is 888-713-2929. If you want to email us, info@malibufunding.net. And of course, you can see the show as well as hear the show. If you want to see the show, you can go to any of the radio stations, KCAA, KMET, and see the show. If you want to see it online, it's themortgagevoice.com, and of course all of those outlets, as well as K-Tahoe, broadcast the show every weekend, as well as, I believe it's on Thursday. Is it Thursday too with KMET?
Yes, I believe so.
Yeah, I think so too. Anyway, so the people who are my clients, and they're trying to get this loan, they just couldn't find a property. 15 different escrows we were in in terms of trying to find the right fit of something that would make sense to them. They're the type of buyer that wanted to get into a property, have their kids graduate from high school. There's 3 of them, and in 3 years they'll all be out of high school. Then they wanted to sell the property and get out. So they had a very specific buy that they had to do, and they just couldn't find something that made the math work. However, if you want something and you want to live there for a long time, the math doesn't necessarily have to work the same way it would if you were doing a income property, whereby you have to have the, you know, the principal, interest, taxes, and insurance paid each and every month, plus the management fees and maintenance costs, as well as to make some kind of profit on that in order to make the thing make any sense. Otherwise, you're just building long-term equity by paying a little out of pocket every month, which is still a strategy. But in this market, we're 2018, let's figure we are at pretty close to 95% of what we're going to get out of this up market. And we're looking at probably in the next 12 to 18 months. Now, I know I'm a doom and gloomer. I know people have told me that. But you figure historically it's 8 to 10 years in this market, any market really, where you're going to see peak valley, peak valley. Now, I don't know whether this is going to be a local issue, whether it's going to be a national recession, whether it's going to be something that is akin. And by the way, hey, Darrell, have you seen the gas prices? What do you think?
You mean at 4+?
Yes, exactly. And the last time they were like this, interest rates were a lot lower. So if you were buying a house, gas prices did not affect you as much because you had the disposable income to buy gas to get to work. But I have a 35-mile commute one way, 70 miles a day to get to work. It's expensive.
Yeah, my wife does as well.
Yeah, it's just unbelievable. I mean, you could be spending $7,500 to fill up your tank, and if you've got a Ford 150 or you've got some other type of vehicle which really chews the gas, oh boy, this summer's going to be tough.
Yeah, well, in California, they added the highway tax that was just voted in to help build, you know, some more infrastructure, repair what we have. And they're saying that some of it's going to the crazy train. So,
well, this is the problem with California, is you really don't know, because those ballot measures, unless they specifically not only earmark, but they set aside and put in what they used to call the Social Security lockbox, but in something that the general fund can't rob it if there's shortfall. Like right now, California's got a lot of things going well for it, right, economically. So that means that the tax coffers are full, which means that somebody's always in your pocket for more money. It's just the way it is. But when the economy goes down, and this is the other point that we're talking about, if you're thinking about buying now and you're at that peak of the market and my clients couldn't find something to buy, what happens when the market turns south? And I'm saying 12, 18 months, maybe 24 months at the outside. If the Democrats win, I think it'll happen a lot sooner. However, when that happens, what happens to all of this? The tax base for the gas, what happens to that? Well, the taxes aren't going to go away. And by the way, I was hearing on another radio station that they're trying to repeal this gas tax, get rid of it. Over on KFI, they were talking about it.
They have enough signatures to put it on the ballot, I believe.
I think they should put it on the ballot. I think if people really thought about that bullet train or whatever the heck they're talking about, the brown dog, I think that's what they call it on John and Ken show. It's really funny. I laugh every time I hear about it.
Well, those were the guys who were calling it the crazy train.
The crazy train, the brown doggle, yeah, they're just, anything that spends your money by people in Sacramento is probably a bad idea, according to these guys. Now, I don't know whether it is or it isn't. Some of the taxes are useful, some aren't. The one in L.A. that kills me is the housing bill that we put sales tax on, creating $1 billion fund, and they're looking for ways to spend it. However, what happens when the next 50,000 people show up because they're hearing about the free housing? Now, I'm a generous guy, and I think there should be a way by which we can deal with the housing problem. And I've outlined it on the show several times, whether it be to allow people to buy, to build granny units on their current property in order to exacerbate the problem of houselessness. It's not homelessness, by the way, it's houselessness, because home is a sort of euphoric name, but a house is a house. Roof over your head, someplace to lay down at night, and shelter from the cold. That is a house. And I think we could probably solve the crisis with the current number of homes we have on the market if we would let those people either rent cheaper and be able to do it, or build units on their current property and be able to rent it out. Now, you could do it by any number of means, either holding rent control down or having government subsidies for the rent that you're not getting because it's not market condition, something. But by continually making it difficult to build housing it only drives the cost of housing up, which means that the cost of any housing on the retail end is going to go up. Therefore, if you have rising interest rates in the mortgage market and the cost of the housing or the building is going up, Las Vegas is a perfect example. If you're thinking that 16% increase year over year is a sustainable thing, that's insane. Those kind of numbers are only existing because of the lack of housing. If we are 1 million units short every year that we need to build in this country in order to house the people that need housing, we're going to have a homeless or a houseless problem for the next 10 years. And I don't think any fund in LA is going to solve that. Anyway, I'm Jeff Barton. I'm your host for the Mortgage Voice, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is the telephone number. Pick up the phone and give us a call. We've been talking about mortgages, your mortgage specifically right now in the springtime of 2018, rounding into summer shape, probably in about 35, 40 days. What's happening to you and your real estate needs? You want to buy a house, you want to sell a house? That's what we talk about here on the show. We bring great guests all the time to the show. One of the guests who's a little bit late showing up today, I wanted to talk to him about what do you do with a borrower when you've got a first-time home buyer and they come to you and they say, hey, you know, I want to buy this house, but they tell me I need a pre-approval letter. I need something from you so that you can give them the warm fuzzy that I'm completely able to get a loan. Well, so one of the articles that I picked up in a magazine, very interesting article on anticipation of borrowers' questions, and this would be to your professionals. So if you're out there right now and you're in this predicament or you're in this situation, or maybe you're a seller and you're getting pre-approval or pre-qualification letters. What are you looking at? What are you looking for? What are the kinds of things that are needed either by the borrower or from the borrower if you're the seller? And that's what this article speaks to. I really like it. One of the things that it says is do not be afraid if your pre-approval letter mentions third-party services. Now, what is a third-party service? I know that in the mortgage transaction, you will see a HUD or an estimation or a loan estimation at some point in the transaction, and you'll look down the itemized list of seller or buyer debits and credits, and you'll just be confused as heck. Even though the language is pretty straightforward, even though it is also also very readable, and the figures that you get on that LE have to match what they are on the CD. And of course, I don't want to get into the nitty-gritty and the ups and downs, ins and outs of what are said, but if you're looking at third-party fees, and a lot of that shows up on your HUD is your estimated closing statement that you might get from your escrow company. Those third-party fees are things like credit, are things like title and escrow. Now, many people who look at costs related to mortgages point to third-party fees as the way by which you can drive costs down. And I'm the first one to admit that there are a lot of fees in there that are padded. But I'm also going to endorse third-party companies. Now, why do I say that? Well, because most lenders aren't going to be able to do everything that's required in that transaction, whether it's title, whether it's escrow, whether it's any other third-party credit, for instance, that's needed. You need professional companies that do professional jobs. These companies exist, and they are needed to. Daryl, I think we have a call coming in. I'm just looking at that. So when you're looking at third-party fees, and you're thinking that, yeah, Chuck has just called in to the show. Charles?
Yes, sir.
Hey, how are you?
Outstanding. How about yourself?
I'm just fine, thank you. You know, we were just, and this is Charles Giscombe. He is the what are you, the qualified employee out in the state of Nevada for Malibu Funding, Inc., isn't that right?
Yes, I am. Branch manager and qualified employee for certain.
Okay, excellent. So before you got on, I was just going through some of what they call third-party fees and why I was in favor of third-party companies, although you have to watch out for the fees. What are your thoughts on third-party fees, whether it be title or escrow or credit or some of the other things that are needed in the closing transactions? Because these always seem to be what RESPA or the federal government or the borrower looks at in order to drive costs down. What do you think about all that?
You know what? It's kind of a good situation for us in regards to third parties because it helps us kind of make arm-length distance transactions occur. Keeps us safe that way. Obviously, you don't want the additional fees, but I understand why. It's just to make sure that there's no control where a particular lender or investor or someone monopolizing a transaction, and that way to make sure that the client is getting the best possible services, unbiased and objective in regards to the borrower, making sure they have the best transaction. And for us, it also helpful to us, Jeff, because we don't have to worry about those things that we just spoke about, and that is, people viewing us as though we're driving costs or doing certain things.
That's right.
I believe that sometimes, or in most cases, although it may be a little bit costly in some situations because everybody's got to make money, but the reality of it is, I think that it's worth the money to make sure, Jeff, that we can provide the best possible service to our clients as far as mortgages are concerned and not worry about the other fees or the other services that are involved with this situation. So we don't look like we're steering or trying to control a transaction.
Yeah, I think that's right. I happen to like third parties that come in and do a professional job. Yes, they have to make money, and yes, that does drive costs up. I think in many respects, borrowers look at costs as if somehow they are all getting ripped off. I think some of the fees are ridiculous, whether it be, tie-in fees or some kind of pad that they put on for an additional whatever it is in the fee, whether it's escrow, sub-escrow, these kind of things. But in general, most of these fees pay for professionals to do a professional job. And I think to cut off your nose to spite your face in terms of making, everybody ground down to dust is not really in the best interest of the borrower.
Not at all, Jeff. I completely agree with you. And like I said, it just makes it easier for us to say, hey, listen, I'm in control of one thing and one thing only. That's to provide that mortgage service for you. The only thing I can control for you in regards to this is our origination fee. We're not responsible for anything else, and it just provides an opportunity for those services to get done the best possible way they can and within the best interest.
Right, and then we could probably include underwriting or processing in these third-party fees. I know that most lenders do their own processing. Yeah, they do, or originators do their own
Correct.
processing, but it can be a third-party fee, as underwriting can be a third-party fee.
Absolutely. It absolutely can, Jeff. Agreed.
Now,
Agreed.
So summer's about ready to kick in. Rates are going up. Where do you think we are headed in terms, and inventory is really tight all over the country. And I just read an article that said that Las Vegas prices have gone up 16.5% from last year at this time.
Yeah, and they may continue to grow. Everywhere that we're looking, Jeff, there is a supply and demand issue.
Yep.
And as that goes, the prices will increase and will increase. Now, obviously, put certain things in place that won't allow the boat to flip over again. That's what they say.
Yep.
And hopefully we don't get there. But I believe it's going to steadily increase. It's going to be a seller's market. It's going to be a seller's market for sure. And, the highest bidder will be in play. And I think that should happen for a while. Now, obviously, things can happen that we don't foresee that can cause it to go into a tailspin. But I do see that it will increase, still go up, and it'll still be a great for sellers, at least for the rest of this year, Jeff. I'm looking at that.
Yeah, I agree the rest of this year. I'm a little bit nervous after the election because we're not really sure what's going to happen. And if it is a landslide of a Democratic variety, I think you're going to see a recession quicker than later. If it's a Republican win, or at least a maintain of what it is, I think you're going to see an economy which maintains because the regulation that's been cut, a lot of the relaxing of what happens, especially with the CFPB in our business or some of the other ones, HUD, and certainly anything having to do with the free access to money has remained pretty strong since this administration has taken over from the Obama administration.
Agreed, Jeff. I agree with all those things. And you know what? You're always worrisome after that election situation.
Yep.
But, you know, you hope for the best. And obviously, in this situation right now with the Republicans in, like you said, Jeff, you know, the money's flowing. It'll keep going, and we'll see. But hopefully it stays on this steady path for longer, you know, for a longer period of time than not.
Now, I just want to touch a little bit about borrowers who are looking for some easy way to get a loan, and I think we call that fraud. There's been an uptick in, yeah, I know we laugh, but it's true. When you see a market like this, whereby the refi market has really dropped by half, so you're probably, rather than a $3 trillion mortgage market this year, are probably below $2 trillion. Now, $1 trillion is a funny number, but at the same time, if you're 1/3 less in terms of loan volume, and programs which have become regular now, which didn't even exist 4 or 5 years ago, the tendency or the temptation to be able to do something to get a loan that you couldn't have even done because those programs didn't exist 5 years ago becomes greater. You got a concern for that?
Absolutely. You know, whenever you get into the fraud situation, Jeff, you know, it's really, you know, that's always tough for us. That puts us in a rough situation. And people, as things tend to tighten up, individuals get more desperate, and they'll look to do other things. As is going on right now, Jeff, in regards to fraud, you know, I don't know, what can I say about that situation? I mean, I believe there's other programs out there that will allow people not to have to get that desperate.
Right.
You know, we always talk about these non-QM situations and things that can, you know, these different loans that are taking, you know, they have similar qualities to the loans of old, Jeff, that we used to do. You know, there's still stated income, stated assets. There's some people doing no income, no asset loans. I mean, obviously it's going to be a lower LTV, might be more FICO driven, so it can put some checks and balances in place. But when it comes to the fraud situation, like, you know, I think that those loans are in place so individuals don't have to go that route.
Right. I agree.
Because that's what the loan does, Jeff. I do believe that is the route to go, and that's why they did that. You know, banks are still lending. They're not lending the same way they did before, but there's still some programs out there that can get some loans done and not have individuals getting desperate trying to get, you know, origination and do different loans and get different loans done.
Hey, listen, Charles.
I hope that's your question.
Yeah, you did, and thank you. I'm sorry we're up against the clock here. I apologize very much. I love having you on, and I love talking mortgages. It's been Charles Giscombe from Malibu Funding. He's the qualified employee and branch manager in Nevada. Charles, thanks very much for coming on the show.
Hey, Jeff, thanks for having me as always. I appreciate it.
Thank you very much. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. Pick up the phone. Give us a call. We talk mortgages on the show. We talk all kinds of things that have to do with your decision, whether you're going to buy, whether you're going to sell. Maybe you want to just sniff around a little bit. Maybe you got some cousins that are moving into town. Maybe you're going to move out to Vegas or North Carolina. Maybe Chicago beckons you. Hey, we have licenses with Malibu Funding, and Malibu Funding is the sponsor for this show, and thank you very much to them for being able to fund the show and bring this information to you each and every week. But offices in 10 different states with Malibu Funding, Inc., and they are here to serve and let us serve you better. That's their logo. So if everybody wants a loan, give them a call. I'm very happy to bring back to the show a long-time contributor to the show who had left home, and now he's come back to us, and I really appreciate it. It's the mortgage doctor himself, Arby Abramian. Arby, how are you?
Good, Jeff. How are you?
I'm fine, thanks. I bet you haven't heard that in a long time.
I missed it.
Oh, that's great. You know, Arby, you have such experience and you've been around a long, long time. Give us your idea what's happening in the marketplace in general down here in Southern California, will you?
Sure. In general, the bond market is not doing so well. So that's because the increase in bond market in the short-term indexes for the lenders. So therefore, the rates have gone up a little bit.
Yep.
As far as transactions, most of the transactions in current market is based on purchases. So I could with confidence say that most of the transactions, 67 to 70% of all transactions are purchase deals. The remaining 30% are refis, and those refinances are based on people gaining enough equity, so now they're doing a cash out so they can invest in future investments.
Now, when cash out refis, let's talk about that for a second. Programs to gain cash out refis are plentiful, or lenders nervous about cashing out more than, let's say, 80%?
Well, there is a limit, and depending again to the type of property. On regular Fannie and Freddie, which are the majority of the loans, you can go as much as $453,100, which is the conforming level.
Right.
Some lenders, they have a limit, but as far as us, Malibu Funding, we are the best. We can help you regardless of the amount.
Okay. Well, that's good news for you. And the programs that you're talking about in terms of, those are conforming, conventional, or are they FHA loans?
FHA, there's a lot more guidelines, rules, and regulations based on FHA. Those are based on conventional loans.
I see.
Now, keep in mind, conventional is not like, what it was 5 years ago. Things
Right.
have changed. So now if the client has a 620 FICO score or 600 FICO score, there is a program.
Okay, so that's a big change, because there was a time, not even that long ago, where 640 was the absolute bottom. And
Yes.
now you're saying 620, 600. Now, for those of you out there who don't know credit score, the difference between a 640 borrower and 600 in terms of FICO score, the risk, that's a big difference.
And programs, I would like to bring this up, take this opportunity to advise our listeners. There are two programs, Home Ready, Home Possible, which are conventional programs. And just like in FHA, those two programs require only 3% down payment, and your debt-to-income ratio can go as high as 50%.
What are some of the other qualifications for those loans? We talk about them occasionally on the show, but give us a refresher.
Sure. Yeah, if you have, I'm just going to pretend I'm the client. If I
Okay.
have a 600 FICO score and my debt-to-income ratio is at 50%, and I have the 3% down, I can qualify for a Home Possible or Home Ready. Those are basically the same programs, except one is with Fannie, the other one is with Freddie Mac.
Okay, and in terms of saving the clients the down payment, who picks up the down payment, or is that just part of the, is this a government program? How does this work?
Well, down payment usually is out of pocket. So people clients save their money and they put that toward down payment. And usually when you purchase a property, there's the down payment
Yep.
and there's the closing cost. But let's say you don't have enough down payment, there's a lot of programs out there. So the programs are called down payment assistance programs, which you can get anywhere between 3% to 5% grant.
Oh, I see. And who grants that? The state? Freddie Mac, Fannie Mae? Who does that?
It's not Fannie or Freddie. Those are state-specific programs.
What's the one here in California, that CalHAFA program? Is that what it is?
CalHAFA, correct.
Right.
And GSFA Platinum EPA program.
Okay. Yeah, that's pretty good. I know that a lot of counties and cities have their own individual ones, and that's a county by county or a city by city. I know Riverside has one, San Bernardino as well, and as you know, we're broadcast to those areas as well as up in Tahoe now, and I want to say hi to all those people who are listening to the show once again on Saturday or Sunday morning. Thank you very much for listening. With us right now is Arbi Abramian, who is a loan officer for Malibu Funding, and he primarily works in those areas as well as Los Angeles and Orange County. What do you think is the difference between this year and last year in terms of not only the amount of money you have to pay in terms of the rate going up, but what are some of the other differences? Is it easier to qualify now? Is it harder to qualify now? Do you see more people competing for those loans?
As far as guidelines, the guidelines have to be done. But as far as if somebody's trying to purchase, if there's not enough houses in the market,
Yep,
the prices
that's true.
tend to go up.
Yep. Yep, and all of these prices that are going up and up and up, and we don't see. I don't know if I told you, but I was telling our last guest, in Las Vegas last year at this time to this year at this time, property values have gone up 16%. Now in LA County, it's about 6% over 6.5% over last year. I don't know exactly what it is in San Bernardino and Riverside, but I bet it's something very similar. What do you think about that? The prices rising, the loss of, I guess, the ability to negotiate on any kind of a deal. You basically have to go in no contingency, all cash, or 100%. It can't be good for the market, can it?
I mean, in my opinion, it's never too late to own a property.
Right.
And I can say, like, the person who purchased a property 10 years ago now is the winner. The person who purchased a property 20 years ago is a winner. The person who purchased a property 30 years ago is a winner.
Right.
So it's never too late because you purchase it in this market. Within next 10 years, 20 years, 30 years, you will gain the equity.
No, I think equity-driven markets in terms of trying to build long-term wealth or retirement or pass a legacy on to your heirs, I think, yeah, property is the only way to do it. Let's see, we have a couple of minutes left. The interest rates, we have predicted that in 2019, right at the beginning, we're probably going to see 5.25% interest rates. What are your thoughts on that?
That is very accurate.
Right.
And I can see from looking at different lender perspectives, since I work with different lenders, the rates are already there.
Yep.
Now it depends on if mortgage bond securities, they start to function better, then the rate will come down. But right now, like everything is linked together, such as the stock market. The stock market is doing very well. So therefore, the bond market is lower and the rates are high, right?
Well, if you're going to get a return in the stock market better than what you can get in buying treasuries, yeah, obviously nobody's going to want to buy treasuries. They're going to want to put their money in the market, which means that you have to up the yield, which means that you have to up the mortgage rates. That's just kind of how it goes. Mm-hmm. I mean, and there is no simple solution to that other than to say, hey, you've had, and I hate this, but the explanation is simple. You've had it well for so long that a little hurt is probably a good thing.
It is a good thing.
Right.
I mean, like, what goes up must come down. So the stock market is high, so it's going to take within next 6 months, or nobody has a crystal ball, but stock market is going to start coming down.
Well, I think it has last week or so, at least. Actually, it's been kind of flat, up and down. Yesterday was, I think, down 177 points. Mm-hmm. So I think in general what you're saying is true, is that the stock market has traditionally been where you go if, in fact, you're looking to make quicker money. But if the market starts to falter, you'll see a return to the bond market and you'll see mortgage rates go down. That's what I think.
Yes, yes.
Hey, Arby, thank you very much for coming on. Thank you, and welcome back to Malibu Funding. That's terrific that you're back doing loans again with Malibu Funding, and really appreciate you coming on the show once again.
Thank you, Jeff.
And thank you very much. That's Arby Abramian, the Mortgage Doctor, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is the telephone number. Pick up the phone, give us a call, or you can email us, info@malibufunding.net. And we're certainly on YouTube. We're on Facebook. Yeah, if you go to Facebook, type in Home Loans, Malibu Funding, Inc., and it pops right up. We got a great homepage there on Facebook. We certainly have malibufunding.net. That's a website, and they're the sponsor for the show, so I want to give them a nice big plug. And anybody else who is out there listening to the show right now, thank you very much. KMET, KCAA, K-Tahoe, and the Roadrunner are big four is what we call them. And you know what? We have a great guest on who, as we were just talking off air, has done a lot of good things for people who need this type of advice. I brought him on because I think, just hearing about success from both his standpoint and how really to help you get to where you need to be financially. And of course, we're talking about Terrell Robinson from WealthWave. I believe your slogan is "A Day in the Life with Big Tex protecting your financial blind side.
That's it, Jeff.
I get it.
It's a day in the life with your man, Big Tex. Who do you want to protect your financial blind side?
Okay, great. And for those people who don't know, Tex was a terrific football player, both at college and in the NFL. And I think that slogan for you is not only apt, but it also represents who you are as a person. Give us a little taste of what you're doing right now to do that for people, if you would, please.
Absolutely, Jeff. Our main motto is, number one, is how money works, because it's not being taught in a lot of these homes, families, schools. So the average person don't know how money works. So what we do is we've set up an educational platform. And right now, next month, when I get back from Texas, I'm setting up something from children that are from the ages of 8 to the ages of 17. I'm actually going to even go to the age of 18 and teach them on how money works, balancing a checkbook, rule of 72. So what we do is we sit down, we take a snapshot, and just ask you some simple, basic questions, such as, do you have an emergency fund? What type of life insurance policy do you have? Because a lot of people out there carry policies that is the wrong policy, accidental and death policies.
Right.
So multiple things that we do in the financial, and we still, Jeff, we still focus on credit too as well, because credit is leverage when it comes to purchasing homes, purchasing vehicles, and so on and so forth.
Now, you've been doing this for quite some time. I know you personally, and you've been on both the radio show and the TV show, and we've become pretty good friends just through that medium. What would you say is the most important thing for a young person to know, not only about money, but about investing and about planning long term? Because most people, they just don't. So what would you say? What was the most important thing that you could pass on to them?
Well, the first thing comes to my mind is the leverage part, and the educational part. You can actually sit down with someone that knows about money, and you don't have to pay them bukus of money. I'm what's considered a non-captive broker. So when you sit down with me, I do a free financial needs analysis. So as a young person, my son now is the age of 26, just purchased his second home a couple of months ago. Now, he does have a little bit of disadvantage because Pop's in real estate and in the financial business. Right. But it was still my job to be able to educate him in regards to, son, when you get a check, make sure that this percentage you're paying back to yourself, make sure this percentage is paying back in regards to reserves. First thing he asked me, well, why is that, Pops? What happens if you lose your job? Do you have an emergency fund built up? What does that mean? Well, will you be able to sustain your lifestyle for the next 3 to 6 months until you can find a replacement, such as when the recession hit?
Right.
So that would be the first thing. The second thing, of course, is credit. The reason I say credit is when young men and women go off to college, these credit card companies come onto the campus, and they just throw cards at you. Their job is not to educate you. Their job is to get you to sign up. But they don't tell you about the 30% debt ratio that you don't want to go over with revolving accounts. They don't tell you about the interest rate or maxing out, because by then, middle school, high school, elementary, you're not taught about really what the compounding and the APR is all about. So you're thinking, hey, if I make this $15 minimum payment on this $1,000 card, I'm in good standing. That's not true.
Well, it hurts your credit if that's the max you have on the credit, which is really first cards are maybe not even 1,000. But if you've maxed it out, you're only paying the minimum. It really hurts your credit score, doesn't it?
Absolutely. It not only hurts your credit score, then you got to look at the longevity of how long it's going to take you to pay that card off. If you continue to, and you're in college, it ain't like you have, and you're an athlete, you can't work. So that means you got to depend on either a scholarship or money from mom and dad. So by that credit card being maxed out, you're already getting a late start. What happens if you need to now apply for a student loan? Well, even though your credit card has been paid on time and you're maxed out, it's dropped your score so many points.
Yeah, and that's a good point to tell people. If you, in fact, have a credit card and you're not maxed out, you want to stay below, what is it, 30% of the 30%. Max? Okay.
Absolutely. Okay. And you want to, I apologize, Jeff, you want to look at the total all debt ratio.
Okay.
So if you have 3 credit cards,
right,
and they're all 3,000. I mean, they're all $1,000 a piece. And if you have one maxed out, well, hey, you're at that that 30% debt ratio. So now you have to.
So it isn't on each individual credit card, Tex? It's on the total of the credit card revolving debt?
Well, if you have one, if you want to look at the total revolving.
I see.
So if you have 4 credit cards at $2,500 a piece, one card is maxed out, your total revolving credit limit is still 25% if you have $10,000 in limit.
Right.
So you only have 500 more to go. Even though that card is maxed out, and you don't want it maxed out, but even if it is, you're at 25% total revolving. But once you cancel out one of those credit cards, different ball game now. Now your debt ratio just went up, and it just dropped the score 50 points, depending on your history, 50 points, 100 points.
Now, let me ask you a question about life insurance in terms of using that as a long-term investment. I know we've talked about it several times, but just give me a little bit of a refresher about how you can use life insurance to really set yourself up for some long-term wealth growth.
Absolutely. See, another misconception is people, I don't want life insurance because X, Y, Z. Well, they don't understand how it works, so you fear what you don't understand.
Of course.
So there are different policies out there that will allow you to be able to develop some cash value. And if it's the right policy, put in the right program, such as an index universal, now if you put the rule of 72 in effect, and let's say that account is averaging 12%, that means your money is doubling every 6 years. But as far as the policy, as you're putting money into this policy, you can also take money out against it because this policy now acts as if that is your own personal bank. So when you get ready to go purchase a home and you have a cash value life insurance policy that has, let's just say, $10,000 in it, and you need to purchase a home, you have $20 in your checking account, $20 in your savings account, but you have $10,000 in that cash value. You are able to borrow that money to go put down on your home. So if you need to put down 3.5% or you need to put down 5%, whatever the case may be, you can borrow that money.
And that's because you've built up the long-term cash value of the account?
Absolutely. And it doesn't even have to be long-term. It could be, here's another misconception, too. You can also, let's just say, for example, if you're putting in $100 a month, and let's just say if you're a commission-based person that works at a furniture store.
Right.
You just had a great month, and you got an extra $3,000 left over after all bills are paid, and you have money left in the savings. If you want to stack in $1,500 into that policy, you are allowed to do that. That is acting as your savings. There is a reason why, because that policy now has what is called a zero floor. It is taxed to the S&P 500, so therefore the market goes down. You do not lose your principal. Here's another thing. That policy, for the most part, is outpacing inflation versus a checking account or savings account.
Of course.
The most I've seen on the checking and savings is 1.6%. But even if you're getting 6% out of this policy, you're still outpacing inflation. The market goes down, you're at a zero floor. That's the most important. Anybody can make you money, but when the bad times come around, can they protect your financial blind side?
Oh, that's excellent and very good advice. By the way, send me a picture, will you? We're going to put it up on the website when the show comes out. You're just, one happy face away from being in touch with everybody, and I really appreciate you coming on the show once again, explaining all this stuff, and really happy for your successes.
I really appreciate it, Jeff. Thank you very much for even having me on. It's truly been a great honor knowing you, getting to know you, and it's crazy how we met.
Yeah.
And for the longest time, we've never even seen each other.
No, I know that. We did a lot of radio, but never saw in person.
Right.
But next time I'm out in Vegas after tomorrow or Thursday, we'll get you back on the TV show. This has been Big Tex Robinson, Wealth Wave, live here on the show, and I really appreciate you coming on the show.
Absolutely. Thank you very much, Jeff.
And thank you, too. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. Pick up the phone and give us a call. We're talking mortgages. We're talking real estate. We're talking what's happening now and in the future. There are many, many different questions you're going to have about how to do the process, how to get into the loan process. And we've talked a lot today about nuts and bolts issues with a lot of different guests that we've had on the show. And so I'm going to continue that trend by talking about the process of getting a loan. I mean, what you need, the documentation, all kinds of stuff like that. Reading from an article, but also my personal knowledge, being in the business for a long time, about, most people who want to do a loan, they do not want to tell everything about themselves financially. It just seems to be one of the most embarrassing things you can do, especially when you think you are telling a story, but yet your credit and your income and your payment history is telling a different kind of story. And I don't know whether that's a positive or a negative, but whether you see yourself as this terrific entrepreneur and this great business person and you're just killing it on a daily, but yet when you look at your year-end taxes, you've written so much off, you can't justify getting a regular W-2 type loan. Therefore, your rate's going to be higher, and you're asking the loan officer, well, why is that? Well, there are, as I said, there are ways by which you can improve your situation in, 3 to 6 months to be able to get the best rate. In a market that we're in right now where rates are rising, and we think by 2019 we're probably going to see 5.25% to 5.5% interest rates. And that is still traditionally one of the lowest interest rates of my lifetime, and I'm 63 years old. So that we've had this very odd market where we've had 3, even in the high 2% interest rates. It's not sustainable, and currently we're in a market whereby the economy is booming, so the interest rates rise. That's just the way it is because it's a control over inflation, and inflation is the #1 problem when it comes to, obviously, equity in your home or prices at the fuel pump or at the grocery store. We do not want to see prices rise too fast, and in order to do that, we have to cool the market down, and that's what we've been trying to do. I say we, but those of us in this business know that rising interest rates for the mortgages are probably a good thing. But let's get to simple questions like, okay, what paperwork do I need to provide to my loan officer? Okay, we need proof of income. We need assets for the borrower. 2 years W-2 tax forms or pay stubs. 2 years of tax returns, personal identification, and information about prospective home buyer's credit. Your credit. I need to know this. Borrowers may also need to provide information about the property, their present and proposed housing expenses, and the reasons for seeking the loan. Okay, that paragraph in this particular article sums up, if I get that information, I can give you a loan estimate and tell you precisely what the loan is going to cost you. It's going to cost you either in fees from third-party providers, which we talked a little bit about earlier in the show, whether it be title, escrow, credit, any number of other processing, maybe underwriting. These can all be considered third-party fees depending. And I can also give you an estimate as to how much money you have to bring in terms of getting the rate you want. Let's say you want to buy down the rate. If you want to buy down the rate, it's called a discount point. A lot of lenders will allow you to buy down the rate, meaning that if you have a 4% rate and you want a 3.75% rate, you can do that if you pay a fee up front, which is called the discount fee. All of these things that you need to know about before you actually choose both the lender, the loan officer, and the rate that you want. Most people, I'll be honest with you, come to you and say, I want to buy a house. How much can I afford to borrow? And that's really how it is, because knowing what you need to know in order to make those decisions to borrow money is, well, it's simple in one respect, and it's not simple in another respect. It's simple because it's just a math problem. But it's not simple because you just don't need to, you don't know what the numbers are. You don't know really how much you make. I made the example of the person who owns a business and writes off all of their income on expenses for the business. Now they're living fine because all their living expenses, the mortgage or their rent or the car payment or any of the clothes or the cars or anything else that you need is all written off against the business as quote-unquote business expenses. However, we all know that they're really not business expenses, but this particular borrower, this particular person is looking at his company as a way to not pay taxes. Now that's between you and the accountants. I don't get involved with that. What I do get involved with is, okay, how much money do you make? And we quoted it. You need tax returns, you need assets, you need pay stubs for 2 years. This is what you need in order to get the best rate possible. And a quarter point on, $100,000 over a 30-year loan is tens and thousands of dollars. So it really does matter, this rate. And because we need to know how much money you make, and it goes right back to the ability to repay the loan. After 2008, big crash, nobody could prove that they could repay the loans that they got because they were heartbeat loans, i.e., if you have a heartbeat, you can get a loan. Well, it's not like that anymore. And since the Dodd-Frank rule, and by the way, they're really relaxing a lot of the Dodd-Frank regulations. We have a new CFPB director, Mulroney, and he's basically said he's not going to do the regulatory, strict interpretation based on what Richard Caudray was doing with the CFPB. He's more or less somebody who's going to look at the landscape and say, in order to grow the economy, we have to relax some of the lending standards. In order to relax the lending standards, we have to adjust the regulatory atmosphere by which loans are being conducted or loans are being made from lenders to borrowers. So in doing that, the regulatory atmosphere allows certain products in the marketplace that just didn't exist 5 or 6 years ago. But in so doing, if you are the type of borrower that has traditional loan information for people who want to give you money, you're going to get the best rate. And believe me, quarter point, half point, even a full point. I've seen loan estimates for borrowers ranging from 4.875 all the way up to 5.25, 5.325%. Now, why would that be? Credit score is one, ability to repay is the other. And these two combination of criteria on your loan are going to determine your rate. And the rate is really very, very important. Now, many borrowers, you may be listening to this thinking, I don't care about the rate, I don't care about anything, I just want to get in the property and can I afford the payment? Well, if you have a good loan officer and you have somebody who's really looking out for your benefit, and by the way, in the loan docs themselves, they have to lay out 360 payments if you've got a 30-year loan in writing, and you have to sign that you see what it is and that the loan payments are fixed for 30 years and here's what they are for 360 days or 360 payments. So if you are a good loan officer, you're going to tell this client, look, you need to know more about this loan than just can you afford the monthly payment. Because it's not today's monthly payment or tomorrow's or next year's. It's when the economy goes bad, and now we talked about this a little bit earlier with Big Tex, who was on the show, talking about what happens to you when the economy isn't as good as it is today. We've lived through that before, but since the last 8 to 10 years, it's been pretty good. Maybe you've forgotten. Maybe those people who were buying a house didn't experience it because they were kids at the time, and now these millennial borrowers want to get out there and buy a home. All right, if you're that person, you need a loan officer or a company or somebody to say, hey, you need to look at your long-term ability to repay this loan. The ability to repay rule is one of the most important things in terms of qualifying for a mortgage, getting the best rate for the mortgage, and being able to make sure that not only are you qualified for that mortgage, but that you can continue to pay that mortgage, all things being equal, for the remainder of the term of the loan, unless you're planning to either sell or refi the property. But in terms of just being able to get the loan, those 6 or 7 things that I mentioned, if you get those things to a good loan person, they can really help you by detailing for you the ability to repay and the qualified estimate the loan estimate that'll lay out the cost for your loan. Anyway, I'm Jeff Barton. Really glad you listened to the show today. I'm here each and every week, and this is The Mortgage Voice, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
On the brink